Good afternoon and happy Thursday, everyone. This is Scott Wohlers with River Place Capital. This is Thursday, March the 3rd, and just wanted to touch briefly on what we saw in markets last week and then talk about current market conditions and really where we see markets moving from here. And there's a lot to get into and discuss, and a lot going on that's driving the forces in the market. So last week, we finally broke the losing streak in the markets. We had a very, very positive week last week with the S&P 500 up 80 basis points or 0.8%. The mid cap index was actually up 1.10%, and the small caps as measured by the S&P 600 again outperformed the large cap index at 90 basis points or 0.9% on the week. So caused that as we saw the Ukrainian people, and it's something that I am just so enamored by and admiring the courage of the Ukrainian people as they are standing up to the Russian agitators in this conflict, and they're doing a great job pushing back on the Russians, and that really was caused markets to really move higher on the fact that the Ukrainians are holding up pretty strong. Now we move into this week, and we saw some selling on Monday, and we saw some significant selling on Tuesday. Again, the war is continuing on, and things like that are proceeding. But what really turned markets around yesterday was we were starting to rebound. Then Chairman Jay Powell had to go and speak in front of Congress yesterday. He's speaking in front of the Senate today. He spoke in front of the House yesterday. And he pretty much signaled things. So there have been three main factors that have been driving this market. And they have been inflation, the Fed and the Fed policy, and now in the war in Ukraine and Russia, the war between Ukraine and Russia. Well, we just got some clarity on the Fed this week as he was in front of the Congress yesterday and testifying that he plans on a 25 basis point rate hike or a 0.25% rate hike in March that he is going to present to his group. Now, what's significant about this is one of the fears that had entered into the marketplace is that the Fed was going to raise rates too fast or too quickly and that they were going to send us into a recession. Well, what he said was with the uncertainty in Ukraine that he sees it prudent that while we still need to tackle inflation, he's willing to allow the economy to run a little hot or hotter than normal or average, and in terms so the Fed doesn't overreact and kill the economy by raising rates. So that took some fear out of the market, and you saw some things really rebound and have a strong day yesterday. And so we still don't have answers yet really on the outcome yet of the conflict between Russia and Ukraine, and we don't necessarily have a sense yet of when inflation is going to wane. We believe that the supply chain constraints will start to normalize as Omicron cases have significantly decreased. You're seeing restrictions being lifted across the United States when it comes to COVID, that we should start to see people coming back and returning back to the office and returning back to work, filling those jobs and hopefully alleviating some of the supply chain constraints that we've seen for the past year and a half, 2 years. So that is going to play itself out. But what investors are saying is the market itself is so volatile that it is changing so rapidly, not day to day, hour to hour. We started the year this year on a very much a value tilt. It was the Fed's going to raise interest rates, therefore compressing margins on high growth companies. So you're going to sell your growth names and buy your value names. Well, as we got scares of the problem with that is if you think the Fed's going to overheat the economy and we're going to go into a recession, those value names are deeply dependent on a strong economy. And so what then you see is some selling going, oh my gosh, we're going to go into recession, so we're moving from value now, and then we're going to move to growth, and then everything looks good. The Fed clarifies things. Now we're moving back into value. And if you're a short term, or if you're looking at it on a day-to-day basis, you can get whipsaw from looking at all of this. So what do you do as an investor moving forward? Well, a couple key things to take away from here. The U.S. economy as a whole is still incredibly strong. So the value play is a play that should hold out for the rest of the year. Even though we're off to a slower start, have you been invested in mainly growth or mainly value stocks, you may find yourself right around the flat line year to date, maybe not even negative year to date. So those have significantly outperformed the growth sector. And if you're in the growth sector, you may have seen your names down 20, 30, and 40%, especially if you were in some very speculative tech, high value tech names. So what investors are looking at right now and where money is flowing to is they're looking for companies that have growth prospects and growth potential, but return cash to shareholders, whether that's in buybacks, whether it's in dividends. They want to see cash flow positive companies that return money to shareholders, and that's where the money is pouring into now from an investor standpoint. But if you're in growth names, if you're in value names, just stay patient, stay the course. Look through these short-term blips that are causing the market volatility. Look with that 1 to 3 year time horizon that you have, and make sure that the companies that you own and hold are the ones that you think have chances to grow in the next 1 to 3 years. Now is a great opportunity to really evaluate your portfolio and your individual holdings and say, is this really belong in my portfolio, yes or no? And so, as always, if you have questions while you're going through that process or ways in which we can help you, feel free to reach out and give us a call. You can reach us at 904 346 3460, or always check us out online at www.riverplacecapital.com. I hope everybody has a wonderful rest of your day. Have a wonderful week. Thanks so much.